Welcome to this week's market presentation. Latest news.
In yet another escalation in the war of Ukraine, NATO intercepted 3 Russian fighter jets that violated Estonia's airspace over the Baltic Sea in a 12-minute incursion. This is the 4th time this year that Russian air forces have violated NATO airspace, this time being the longest. The European Union and NATO members are calling it, quote, reckless behavior and a, quote, dangerous provocation towards NATO, while Russia has tried to downplay the incident, stating that the route of the fighter jets was just 3 kilometers away from the border and were flying over neutral waters. Adding to the, quote, Russia testing their limits narrative after similar cases, especially the drone incursion the previous week, NATO and European members are moving towards swiftly approving a 19th round of sanctions and taking a stronger stance against such Russian provocation. The impact on energy markets and prices has remained limited, with the main concern of such miscalculation potentially triggering a wider conflict, especially in the case of NATO forces shooting down a Russian plane, could lead to much more negative consequences. Additionally, as tensions rise between Russia and NATO members, the prospect of additional sanctions and tariffs that could further curtail and weigh on Russian energy exports are weighing on the market. Then, over the past week, moving over to the United States, the Federal Reserve lowered its key interest rate by 25 basis points for the first time this year in a widely expected announcement. Officials have signaled that they are expecting 2 more interest rate cuts this year, 1 more than many market participants had been pricing in due to the rising risk confronting the labor market. At the same time, as the Federal Reserve began lower interest rates, inflation remains stubbornly above the 2% central bank target and could further be exacerbated by the decision to lower rates. The impact on energy markets was subdued, with energy prices, particularly in North America, not seeing a significant reaction to the news. In general, the decision to lower interest rate cuts is expected to boost the US economy and, as a result, boost consumption of commodities, while at the same time, the interest rate cut is a reflection of a weaker US economy and labor market, which could signal lower demand expectations in the future.
Weather.
Moving on to the weather forecast, temperatures across Europe for much of this week are forecasted to come in below the seasonal average, especially at the beginning of the week, before warming up slightly at the beginning of next week. Precipitation, which had been rather limited over the last few days, remains so over the next 7 to 10 days, with not much rain forecasted across Europe. Over on the average wind speeds, there we see good levels of wind speeds, particularly across Western and Central Europe throughout much of this week, adding a boost to wind power generation expectations. And then lastly, looking at the Atlantic hurricane outlook, we see a much more eventful forecast over the next 7 days. We do see a large Category 5 hurricane named Gabrielle in the mid-Atlantic, although its projected path puts it moving further into the Atlantic, away from the United States and away from natural gas production and export facilities. We are also seeing a 40 to 60% chance of a tropical cyclone or hurricane forming there in the Bahamas, and a greater than 60% chance of another cyclone forming in the mid-Atlantic. At the moment, it is too early to tell if those potential hurricanes or tropical storms will materialize and what path they will take, and whether they will importantly impact LNG exports out of the US. As we can see here, compared to last year, this year's hurricane season has been very uneventful, with very few strong storms or hurricanes forming, and so far none having moved into the Gulf of Mexico or made landfall in the United States.
Macroeconomics.
On macroeconomic data, we've received latest inflation figures for the month of August for the Euro area, Japan, and the UK. In the Euro area, we see both the year-over-year inflation rate and core inflation remaining steady month over month. While over in Japan, we are seeing a deceleration of inflation down to 2.7%. Lastly, looking at the UK, we see year-over-year inflation remaining steady at 3.8%, with core inflation easing down just slightly by 0.2%, but nonetheless staying noticeably higher than in Europe.
Crude oil and LPG.
Global crude oil prices saw a relatively stable price evolution over the past week. Prices for the front month moving down by less than half a percentage point, while prices for the front year decreased by around 1% for both WTI and Brent crude oil prices. The stability in crude oil prices is owed to largely unchanged fundamentals. On the demand side of things, the US-initiated trade wars continue to weigh on global economic growth and as a result on future expectations for crude oil, while the slower performance of the US economy is similarly weighing on oil consumption. Over on the supply side of things, given the continued production quota increases by OPEC plus, supply expectations for the coming year are very robust. Overall, market expectations are for an oversupplied crude oil market in 2026, keeping oil prices at near 4-year lows.
Natural gas.
Natural gas prices saw a pretty stable price evolution over the past week, with prices for the remainder of 2025 decreasing by just around 1% week over week. For the front year pricing, we see a 0.5% decrease week over week, so quite minimal, with years further along the curve seeing little to no movement over the past week. European gas storage levels continued their upward trajectory over the past week, settling just around 81-82% as of the end of last week. The injection rate into storage has decreased over the last couple of weeks, in line with the decreases in the total supply due to the Norwegian gas maintenance period this month. Nonetheless, the injection rate has remained above the past 12-year average and, importantly, above last year's levels, which has contributed to a narrowing of the gas storage deficit versus the previous year to just around 12%. In terms of total supply and total demand, we see an uptick in total demand compared to especially a couple of weeks ago, while total supply has remained quite stable week over week. What is important to note is that as Norwegian gas flows has decreased quite noticeably from a few weeks ago due to that scheduled maintenance, it has not dipped to as low as during 2023 or 2024. At the same time, as those Norwegian gas flows have remained lower than typical, LNG sendouts have begun their upward trajectory over the last few weeks, moving up to near the top of the range over the past 5 years. The increase in LNG sendouts also corresponds to an increase in LNG imports into Europe, with the share of global LNG exports towards Europe increasing over the last few weeks from around 20% in the middle of August, now upwards getting closer to 25%. At the same time, the share of exports going to Asia has dipped over the past week. Looking at the investment fund positions for TTF futures, we see a relatively stable evolution over the previous week, with the level of net long positions at the lowest levels this year and closer to levels we were seeing in early 2024. The outlook for natural gas futures remains uncertain, especially as we contend with the uncertainty over this winter's weather conditions, which would have a significant impact on natural gas consumption and storage levels. At the same time, as global LNG export capacity increases, the supply outlook for Europe has brightened at the same time.
Coal.
Coal prices have seen a slight uptick for the front year when we look at the API2 index by 1.6%, but overall have remained relatively downwards over the past few weeks, with prices down around 3.5% over the past month. European coal prices continue to be weighed down by the weaker overall demand for coal. The slight decrease in natural gas prices, alongside the uptick in carbon prices, as we'll see later on, fueling some additional coal to gas switching, further reducing demand from the power sector. The moderate temperatures and the uptick in renewables similarly weighing on coal demand from the power sector, and at the moment still not seeing noticeable amounts of heating demand just yet.
EU and UK emission allowances.
In terms of carbon allowances, as I just noted, we've seen a further increase in the price level in both the European and UK markets. European carbon prices have risen around 2.4% on the week, continuing the upward trend we've seen over the last few weeks. On the UK side of things, the uptick came in at 2.7% week over week. During the last auction for European allowances, we saw a higher cover ratio than indicating stronger demand for allowances, potentially tied to the upcoming compliance deadline on September 30th. The continued expectations and work towards relinking the European and UK carbon markets is adding upward pressure on the UK market, and given the increases in the European side of things, is further adding to the upward pressure on UK prices as well. One factor limiting the upward pressure on carbon allowances is the fact that power sector emissions across Europe have remained at the lowest levels in at least 5 years, particularly over the past week, as emission levels decrease even further. The decrease in emissions over the past week very much driven by the uptick in renewable power generation and the corresponding drop in fossil fuel power generation, as we'll see more clearly later on. Investment fund positions have been taking note of the continued bullish price evolution in carbon prices, and we've seen net long positions in both the UK and European markets reach new record highs over the previous week.
Electricity.
Electricity prices have seen upward movement over the past week, with prices for the remainder of 2025 increasing around 2.5% for German power prices, with the front year up 1%. The upward movement in electricity prices in Germany, and as we'll see across Europe, in part driven by the upward movement in carbon prices that we've been seeing over the last few weeks. In terms of other European markets, we see a similar trend across Europe, with just a couple of exceptions, particularly in the Iberian Peninsula and in France, where we see the increase and the pressure on the market from carbon prices be more limited. Over in the Nordics, the drier weather forecast also contributing to some more bullish sentiment in the market. In terms of the fundamentals, we see the slight increase week over week in total grid demand, while residual load saw a dip over the last week. Overall, both total grid demand and residual load do remain near the lowest levels we've seen over the last 5 years. In terms of the supply mix across Europe, we note the improved performance of nuclear power generation as of late, with output near the top of the range over the past 5 years and in line with last year's levels. In terms of renewables and fossil fuels, we see that noticeable uptick in renewable power generation, primarily driven by an increase in wind power generation, although solar power also saw weekly increases in total output. At the same time, given the uptick in renewable output, we've seen a corresponding decrease in fossil fuel power generation. In terms of renewables, we see that uptick in wind power generation, with output at the highest levels over the past 5 years for this time of year. While in terms of solar power generation, while we are seeing that seasonal decrease in total output, there was an uptick week over week, and even still, we are seeing record high levels of output for this time of year. On the other hand, weighing renewable energy output is the poor performance of hydro, particularly hydro reservoir generation, which, as you can see here, saw a decrease over the last couple of weeks, pushing output to near the lowest levels over the past 5 years. Fossil fuel power generation saw a corresponding decrease in output due to the uptick in renewables, and both gas and coal-fired power generation are seeing lower levels of demand. Especially looking at coal power generation has seen the lowest levels over the past 5 years. And lastly, looking at the guarantees of origin pricing, we see a bearish price evolution across technologies and across years of production, with quite bearish evolution over the past week. The brighter outlook for renewable power generation in 2025 is certainly weighing on the market by increasing the expected supply of guarantees of origin in what has been a pretty volatile summer with significant movements up and down over the last couple of months. Nonetheless, the bearish price evolution very much reflective of the improved output outlook. Although further along the curve, we do see some slightly smaller decreases, in part due to the greater demand expectations then.
That covers this week's market presentation. Thank you for joining.